Welcome to the deep dive. If you're tuning in, you want insight fast. Today we are cracking open the latest from a real giant in enterprise software. We're talking ServiceNow. We've got their investor presentation and the 10Q filing for Q3 2025 right here. And our mission, it's simple. Go past the headlines. We need to really unpack this AI platform for business transformation claim they keep making. We'll look at the financials, see if the numbers back it up, and figure out what's really going on with their customers and, their future growth.
That's exactly right. ServiceNow, you see, they're not just selling software licenses anymore. They sell themselves as the connective tissue. They want to be the essential AI layer for any big company doing digital transformation.
Huh.
And the scale is just massive. Think about it. Around 8,400 global customers. That includes, what, over 85% of the Fortune 500?
Wow. Okay.
So when ServiceNow makes a move, you feel it across the whole enterprise landscape.
Okay, so let's unpack that transformation promise. Where exactly are they focusing? What are the core areas? Because transformation isn't just one thing, right?
Precisely. And they've actually structured their whole platform around 4 distinct workflow areas. Understanding this is really key to seeing how they expand within an account. It's definitely moved way beyond just, basic IT help desk stuff. So first up, you've got technology workflows. This is their original strength, their foundation. It's all about making the core tech infrastructure work better, making it resilient, efficient, secure. Think IT service management, security operations, that kind of thing.
Right, the classic ServiceNow bread and butter. But where do they go from there? How do they start selling more?
Well, that leads straight into the second area, core business workflows. This is really about streamlining and cost-cutting in other departments. They offer these sort of guided, easy-to-follow processes for functions that are often, let's be honest, a bit messy. HR, procurement, legal, finance.
Oh, okay.
So think about replacing, some clunky old expense system or
Right.
the way legal requests come in. They want to pull all that onto their single platform, make it smooth.
Sounds like they're stepping on the toes of the big ERP players like Oracle and SAP there a bit. What about dealing with customers?
Good question. That's pillar number 3, CRM and industry workflows. Here, the idea is to stop companies juggling like 5 different tools for sales, service, delivery. They want to use their AI to orchestrate that whole customer journey intelligently, all from one place. Their pitch is basically, why stitch things together when our platform can manage it all?
Okay.
And then the fourth one, which is really seeing some explosive growth lately, is creator workflows. This is their low-code and hyper-automation play. It basically lets companies build their own custom workflow apps fast, often using drag-and-drop tools right on the ServiceNow platform. It's about giving them agility.
So the big picture they're selling is this central ServiceNow AI platform connects all those dots: technology, core business, CRM, and creator. And the idea is that by connecting them, you get more value out of the tech you already have, these siloed systems, and you cut costs at the same time.
Exactly. It's a smart pitch. Centralization through AI pays for itself. They want to be the central nervous system for the enterprise, forcing all those older separate systems to talk to each other through their AI and data layer.
Okay, strategy makes sense. Let's pivot to the numbers. Q3 2025 looked strong, but you always emphasize looking at constant currency, especially for global companies like this. Why is that so critical?
Oh, absolutely critical.
Yeah.
You have to strip out the noise from currency fluctuations.
Uh-huh.
Otherwise, you might think growth is stronger or weaker than it actually is operationally. Favorable dollar swing can inflate the numbers. So on a constant currency basis, which is the real measure of the underlying business, subscription revenue in Q3 hit just over $3.2 billion. It's a very strong 20.5% year-over-year growth. The core engine is definitely firing.
And that brings us to a number I find really fascinating, maybe the most telling one, RPO, remaining performance obligations. This is future revenue, already locked in contractually. Why is this metric arguably more important than current revenue right now?
Because it speaks volumes about stability and, frankly, their competitive moat. Total RPO hit a massive $24.3 billion in Q3.
Wow.
And that grew 23% year over year in constant currency. That's not just a pipeline. It's a fortress of future revenue.
Mm-hmm.
Customers are signing these long, multi-year deals. They're betting heavily on ServiceNow being integrated deep into their operation.
It makes it hard for anyone else to come in.
Exactly. It makes it incredibly difficult for smaller, maybe more niche AI players to displace them easily. And even the current RPO, the slice they expect to recognize in the next 12 months, that's $11.35 billion, also growing strong at 20.5% year-over-year constant currency.
Yeah.
It's a huge predictable backlog.
And they seem to be turning that predictability into serious profit. The margins look really healthy. We're seeing efficiency gains.
Definitely. They're really leveraging their scale now.
Right.
Look at the non-GAAP operating margin, 33.5%. I mean, think about that. Over a third of subscription revenue dropping to operating profit. That was a big jump sequentially, up about 250 basis points year over year. Real operational leverage kicking in. And their non-GAAP free cash flow margin was also solid at 17.5%, up about 50 basis points from last year.
And that feeds into a pretty hefty non-GAAP diluted EPS for the quarter, $4.82. Shows they've got the cash flow, the financial muscle to fund everything they want to do, which brings us to the customers themselves. Where's this strength coming from? It's got to be more than just signing new logos.
Oh, absolutely. It's about the quality and loyalty of the base. Retention is obviously high, but you need to look at the big spenders, the mega customers.
Yeah, let's talk about that. How are they doing with the really big fish, the ones who are basically running their operations on ServiceNow?
They're doing very well there. As of Q3, they had 553 customers, spending over $5 million a year in annual contract value, ACV. Yep. And it's up from 469 just 1 year ago. So what's that? Nearly 90 new $5 million plus customers in 12 months. And the average ACV for that group is now $14.6 million.
That's significant scale per customer and overall loyalty. The headline renewal rate was 97%. But hang on. Given how embedded they are, is that really loyalty or is it just incredibly high switching costs?
That's a very fair point. It's probably a mix of both, leaning heavily on the latter. 97% is still very strong, of course.
Yeah.
And they did point out it would have hit 98% if not for one large U.S. federal agency customer that actually, well, ceased operations.
Okay.
But yeah, fundamentally, once a company has ServiceNow running IT, HR, legal, maybe customer service, ripping that out is a massive, costly, and risky undertaking. They become incredibly sticky.
And that stickiness, that integration fuels the land and expand model, right?
Right.
The cohort data usually tells that story well.
Oh, the cohort data is stunning. It really shows the power of the platform strategy over the long haul. Take the group of customers who signed up way back in 2010. As of Q3 this year, that original group has increased its spending, its ACV, by 288%.
288%. Wow.
Yeah, it proves they are exceptionally good at selling more modules, more workflows, getting deeper and deeper into those accounts over time. The platform sells itself once the foundation is in.
So if we look at where the new money is coming from, now the net new ACV in Q3 technology workflows is still the biggest piece?
Still the leader, yeah. Came in at 53% of net new ACV. But you're right, the mix is definitely shifting.
How so?
Well, core business workflows plus the CRM and industry stuff, together they brought in 24% of the new ACV. That's significant. But the real story, the one catching everyone's eye, is the creator workflows, that low-code segment. It contributed 23% of the net new ACV in Q3. And that's up hugely from just 15% a year ago. Real acceleration there.
23% from creator. That's fascinating. Why do you think low-code, dry-no-code is suddenly surging like that in big companies? What does that tell you about maybe skills gaps or internal needs?
I think it tells us a couple of things. First, big companies have this huge appetite for custom apps, for very specific process improvements, and traditional IT development just can't keep up. There's a backlog. Second, it suggests companies realize that centralizing IT and HR is great, but they also need tools to innovate faster internally. And they want to do it within the security and governance of the main platform, not using random tools. So that 23%, it shows ServiceNow is becoming an innovation engine too, not just a system to run things.
Okay, so strong financials, diversifying growth. Makes sense they'd be using their cash to double down on AI. The M&A activity this year looks very focused.
Extremely focused. They're not just buying cool AI tech, they're buying capabilities they can plug directly into their existing workflows. It's all about vertical integration.
Right, like the deals that closed this year. They bought Logic.io, that's an AI tool for configure, price, quote, for about $500 million, and also Data.World Inc., which helps companies catalog and understand their own data. Both seem designed to make the platform smarter immediately.
Exactly. And then there's a really big one pending, Moveworks Inc. That's roughly a $2.9 billion deal.
Wow.
Yeah, huge. And Moveworks specializes in these agentic AI assistants, think autonomous AI agents that can handle IT support requests or employee questions. Integrating that deeply could be a game changer for service delivery. They expect that to close late this year or maybe early 2026.
And they're not just buying companies outright. They also made that big strategic investment, didn't they, in Genesis?
That's right. A $750 million investment buying preferred shares in Genesis. Genesis is big in AI-powered customer experience, call centers, that sort of thing. It signals they're building partnerships, too, extending their ecosystem reach even where they don't own the whole stack. It's about controlling the orchestration layer.
Okay, makes sense. Now, before we get to the official outlook, we have to address something pretty serious that came out in the 10Q. A governance issue, a risk factor that hits right at the top leadership level.
Yes, you're referring to the compliance investigation around the hiring of the former U.S. Army CIO back in March 2023. That's a very significant disclosure. The company confirmed they ran an internal investigation into that hiring process.
And the outcome was not good. The investigation found that both the company's president and chief operating officer and the person they hired had violated company policy, potentially related to a conflict of interest, and this led directly to both of them leaving the company in July 2024. The president and COO departed, the other individual resigned.
Yeah, and this isn't just an HR matter. Losing your president and COO over a compliance breach, especially when you're in the middle of trying to digest a massive $2.9 billion acquisition like Moveworks, that raises serious questions. Questions about internal controls, about risk management at the highest level. And the company also stated they're cooperating with the Department of Justice investigation into it all.
Definitely a critical factor for investors, for anyone watching the company to keep in mind. Okay, so with that context, let's look at their forward guidance. Despite that issue, they seem confident about the rest of 2025.
The underlying business momentum seems intact, yes. For the full year 2025, they're guiding for subscription revenues to maintain that strong growth clip around 20% year-over-year in constant currency. The actual range is pretty tight, $12.835 billion to $12.845 billion, and they're still targeting a full-year non-GAAP operating margin of 31%. So continued efficiency focus.
Okay.
However, there's a specific note of caution in the Q4 outlook. They explicitly mention potential headwinds from U.S. federal agency budgets, tightening belts, the impact of the recent government shutdown possibly delaying when deals get signed. Remember, they lost one big federal agency account this quarter already.
Right.
So it sounds like they're just managing expectations a bit for that specific sector in Q4, maybe slower deal closures.
Got it. And one less quick item, a stock split.
Yes, purely administrative, but noteworthy. The board approved a 5-for-1 common stock split, effective after shareholder approval, which is expected around December 5th. Just makes the shares notionally cheaper, potentially improves liquidity.
Okay, so let's try and wrap this up. The big picture seems to be ServiceNow is executing really well on this platform strategy. They're diversifying where the growth comes from.
Absolutely. And they're betting heavily on AI, both building it in and buying it through these big acquisitions and investments, all while keeping margins high and generating lots of cash. And they're sitting on that incredible $24.3 billion RPO backlog. That's a huge safety net.
That backlog definitely shows the market believes in the long-term vision. But given everything we've discussed, the pace and size of these acquisitions, like Moveworks and Logic.io, needing integration. And layered on top of that, these very recent, very high-level departures due to compliance issues. Here's a final thought for you, the listener, to chew on. How much management time, how much focus, how much capital is going to get diverted over the next year towards just integrating these huge new pieces and fixing internal controls or dealing with investigations? And could that distraction, that drain on human capital, potentially slow down their ability to actually convert that massive $24.3 billion backlog into recognized revenue as quickly as they'd like?